Hello and welcome to the sixth of eight sessions as part of ICISA's Surety Week 2023. I'm Daniel Deubert. I'm the Head of Public Affairs for ICISA, and I'm really pleased to be moderating this session. I hope, as for our audience, you've been able to join us for some of our earlier discussions, particularly the one earlier today on financial guarantees, which generated quite a lot of discussion. And as a reminder to our audience today, if you look in the bottom right-hand corner of your screen, there'll be a questions tab. And we really strongly encourage you to put all of your thoughts and your comments and your questions into that throughout the session. And we'll try to get to those as we go through this conversation. Really, the interaction is what makes these sessions work well. So we encourage you to put as many questions as you have into us. In this session, we'll discuss underwriting a private equity-owned company. I'll come on to what we mean by that in just a moment, but perhaps we can start with a round of introductions from our distinguished panelists. Miriam, could you go first?
Sure. My name is Miriam Vogel, and I'm the head of leveraged finance at Commerzbank. We are roughly 18 people on the ground. Ground means London and Frankfurt for us. We do the whole range of financing, starting from tap financings to larger capital market financings, including underwritings. Primarily for the DACH region, Western Europe, and the Nordics. And part of our strategy is also to have a whole book, which is shortly below 3 billion. And therefore, we also have a lot of portfolio companies where guarantees are required. And I think this is part of the topic for today.
Yeah, for sure. Stefan, could you go next?
Yeah, my name is Stefan Kruse. I'm financing professional at Triton. Triton is a private equity house with more than 300 employees, pretty much centered in Europe, so DACH region and Scandinavia. We have more than 300 people working for us worldwide. Out of a 5 billion fund, we do investments. And our focus is building better businesses. And I'll come to that in a minute.
Mm-hmm. And last but not least, Markus.
Thanks. My name is Markus Deubert. I'm heading up as the head of underwriting, the credit and surety part of Zurich, Germany. And whatever it means, we're responsible for a couple of countries, especially domestic and also eastern part of Europe, but also some other countries too. And yeah, the reason why I'm here is because we're working together with companies like Triton and here Stefan and banks, especially in supporting and trying to earn money out of the surety needs within a, let me say, PE transaction, whatever that means. Mm-hmm. And many thanks for having me.
A great pleasure to have all of you. Thanks very much for all of your time to take part in this today. As I mentioned, I think starting out by clarifying a little bit about what we mean by this title, particularly for those who are not directly involved in the insurance sector, and hopefully there's lots of people in the audience who aren't and are interested in learning about how the surety sector views this. What do we mean by underwriting in this context? Well, we're talking specifically about the surety, the insurance meaning or understanding of that. And that, I guess, means a lot of detailed research, analysis of the risk, and usually developing a close relationship in the surety sense with the beneficiary, but also with the principal or the contractor involved in the bond. Underwriting also in this context means that the surety is accepting the risk onto their balance sheet. So I think it's a slightly different meaning than we see in financial services and sometimes in other parts of financial services. And sometimes the fact that we use different terms or the same terms in different ways can be a little bit confusing across the industry. But hopefully today we'll clarify some of that. But our conversation is about private equity specifically. So Stefan, as you work in that space directly, maybe I can start with you and ask you to perhaps define what we mean by private equity. What does it mean for you? And I guess does it look like when it's done well?
Well, I think there are various types of private equity investors. There's, of course, a lot of competitors of Triton doing good to great businesses. So there's already a nice and attractive and cash flow rich business, and they want to do it even better. So that's what the good to great investor may do. Then there's Triton. We would also like to do that, but usually we prefer to build better business strategy. That means not squeezing the lemon even tighter and just turning out every cent and putting absolute maximum leverage on the target. But try to develop something, meaning let it grow. Employees should, the number of employees usually raises under Triton ownership, so we can show that on average we have 30% more employees when we sell compared to the time we bought. So we love doing buy and build and operational restructuring, meaning we have industry experts who have done similar jobs as CEO before when they retire and are happy to be on our boards. So that's what Triton does. And then there is, of course, a third group, which I would say you can maybe be more afraid of. That's distressed and people who are looking for opportunities and then maybe make a return on the cost of the lenders. That means sureties, bank lenders, whatsoever. That's not what Triton does. And I'm happy to say I'm now 14 years with Triton, but even before, no surety or guarantee lender has ever lost money with a Triton deal, which underlines that we believe you see each other a lot of times. So we want to have a relationship to our lenders. And that includes guarantee or surety lenders, because we think from our perspective as private equity owners, we love to be transparent. You can get a nicely monthly or quarterly reporting from us. And I think we do, from the lender's perspective, a lot of things much better than a conglomerate, intransparent, run by an 80 years old founder, not even providing a consolidated balance sheet. So you can choose what is the preferred client for you. So we would love to do a long-term relationship lending, and that includes non-cash lenders. And some specifics, if you look at a private equity deal in the consolidated balance sheet, you are obviously always see a lot of goodwill, because we pay more than usually the asset value, and there may be shareholder loans. And from both, I think you shouldn't be afraid, because the goodwill is not a liquidity event. Even if it would be too high, it's not something where the guarantees or sureties get at risk, because liquidity is more important. And shareholder loans, you can trust, are always very, very deeply subordinated. So they are quasi like equity. Why don't we put in equity directly? It has something to do with management incentive programs and so on and so on. So usually we do a little equity, but the rest is shareholder loan. A private equity owned company should have a very good CFO. At least that's my sparings partner. So we strive at getting best CFOs possible. We need and want transparency on our numbers and economic development. And you can trust us, liquidity management is a very high focus. So we will never want to lose an investment because, all of a sudden in 3 months we have a gap to be bridged, which we were not aware of. And that's why we care about our relationships to all lenders, including insurance companies with sureties and whatsoever. So my kind of perspective is, yes, maybe more difficult to explain the private equity owned balance sheet. But I think we, from our side, would love to treat surety partners equally, but we would also like then partner on the other side, which understands sureties. If there's a regional manager somewhere in Nebraska having a private equity deal first ever in his life, that makes things more cumbersome for everybody. So that's, I think, a brief overview on private equity.
Yeah, that's a good starting place. I guess you touched on maybe what some of the misconceptions are. Would you say and you mentioned, say, some of the things that maybe don't look so nice when you work with a private equity. Is it about, for you then, skin in the game and a communication with different partners? Is that what makes a good relationship?
Absolutely. I mean, there's no reason why we would hold back information bank lenders would get and why guarantee or surety lenders would not get. I mean, happy to provide them, but if they never ask for it, well, then we are not just throwing it around them.
Yeah, that makes sense. Miriam, if I can turn to you briefly then. Many banks have exited leveraged finance, but Commerzbank has not, and you're working in that department. Why do you think it is that Commerzbank is interested in this segment, and what do you find interesting about it?
Yes, I mean, why are we? I mean, we are now 25 years in that business as bank, and I think if you look at leveraged finance and I mean PE or financing PE on companies, the idea is always that you usually try to max out the leverage that is put on a business. Just by nature, that means that there is higher risk attached to that, right? And that, of course, means that a balance sheet also looks different compared to an investment grade company. And I guess this is probably also already the one of the biggest thoughts one has to go through. Probably also the majority of Markus' world is looking at investment grade corporate deals, and there you do the balance sheet analysis. Whereas in the leveraged finance area, I mean, we finance future cash flows. We do cash flow lending, and we finance a future business plan. And the future has always more uncertainty compared to the history when I look at the assets. So I think in principle, leveraged finance is a business that has higher risk attached to that, and you need to be able to manage that. On the banking side, I mean, there is the market risk when you do underwriting, but if you book also a transaction in your whole book, then you have to manage, or you need to be able that the credit risk is also the right one for you for a period of 6 to 7 years, because this is the usual time frame of an LBO financing. And of course, you should get it right. And I think this is the point where some banks maybe also have exited that, because the higher risk also leads to higher attention from the regulator's point of view. I think the ECB, has clearly pointed out that they are against taking too much market risk, and they also screen the bank portfolios when it comes to the risk that is in the holding portfolios. But you need to understand what you do. You need to be good in analyzing the targets, the companies, the PE, private equity players want to buy. You need to understand the structures. You need to know what the difference is between maybe a covenanted deal, a CAF-light deal. You need to understand how an intercredit agreement works. And you should also know the participants in that whole sphere. And that includes maybe the other banks and parties in a consortium for the financing, but of course also the private equity player. So the good thing about that industry is there are certain market standards. So there is clear orientation, and you always have a lot of access, a lot of information, but you need specialized knowledge, I would say. Then you are able to manage that risk adequately.
Right. And I guess then it goes to what Stefan was saying as well, that you would prefer to work with someone who knows this market well rather than someone who's coming to it fresh. Is that right?
Yes, I mean, and the point is simply, from my point of view, I think having insurers being part of the consortium is of value if there are great guarantee requirement needs. And one also has to be clear, usually PE is just, one minor step in a whole company history, right? So, there might be a lot of good relationships also before a private equity player has entered the space, and probably a lot of Markus' colleagues know a lot of the companies already. So they are the natural partner for that. But of course, it's easier if everyone sits in the same boat for the 6 to 7 year maturity of that financing. And that means we all know what are the information rights we have, what are the event of defaults, what are we allowed to do, where is maturity voting, things like that. It's easier and usually guarantees are an operational requirement for the company. If something like that would fall away, or just the maturity would be only 2 years, it would be also a danger for me as a bank, because I would say, how can I cover that if Markus' guarantee facility part falls away? So I would also want to have the certainty, and you have the certainty if everyone is in one big agreement and knows, we sit in one boat and we have to keep going, right? So,
for sure. Markus, then you are coming from the surety perspective on this. What has been your experience? I'm sure you've seen good and you've seen bad. What's your take overall?
First of all, I would like to confirm Stefan's and Miriam's statement completely. And yes, we have mixed feelings. We have mixed experiences. Yes, we had some accidents historically. But that had to do finally with missing discipline or partnering with partners, especially in the PE segment, which are not real PEs. And that provides me one statement: a PE is not a PE, because we have typical, extremely different types. What Stefan said, distressed, right? We have the mezzanine guys and ladies, we have the gross capital guys, and we have the leveraged as an, let me say, as an overall topic, but there is not a clear differentiation between all of them. And then we have, like Miriam indirectly, let me say, confirmed to me, what type of PE do we have? Do we have a boutique with no track record? Do we have a, let me say, a regional PE company with a good track record, which is extremely transparent, wants to, like Miriam said, to treat each and everybody equally? And what is their strategy? Stefan mentioned buy and build. Fantastic. But we also had historically some private equity companies, and minimum one of them was based in Germany, Munich. They have been specialized in asset stripping. And that was a nightmare, because when, let me say, a financing exploded, which for me, it's sure it is part of it, we had a loss. So we could not participate in the gains of that asset stripping. So that's one of the most important critical things to assess the PE company, right? What is the real strategy? How can they support? Do they use own money? Do they use fund money? Do they need regular distributions like management fees, consultancies fees, which is also something like, for me, a cash flow stripping, right? Which has nothing to do with the leverage, which is completely different. And this is something which has to be assessed. And therefore, yeah, it needs specialized knowledge and especially experience and good partners, which are extremely transparent, which are treat each and everybody equally. And therefore, we have mixed feelings. Yep, we have an unofficial, I have it. I cannot say it officially for Zurich, but I have a blacklist, and it could be the best financial model solution for a company. I would never support, because that PE company is on the blacklist. We never know what's the real strategy. And this is so important, beside the complexity, for us to really understand who is the partner from a PE perspective, what is the clear strategy, and then, as Miriam stated out, the funding strategy as such, and how are all the partners treated. Because sureties like us, we love to be part of syndicated loans, even when they're committed, because this provides an opportunity that each and every partner is more or less treated equally. And we're sitting in one boat. Short, some words, I could go ahead, but to write some notes to give an intention for somebody.
And I guess then you're saying there are things that a surety needs to be mindful of avoiding. Are there things that they need to be proactive in ensuring when they're in this situation as well? Are there things that they can do at the outset?
I'm not sure what you mean with proactive. Let me say, we always want to do business. We want to earn money. And in case we would not use our name and our capacity for providing surety capacity or trade credit limits, right, we will not earn a penny. So we are forced. But that's also an additional criticism. If we have a PE partner and or bank which has pressure, PE partner to invest the money, or a bank to grow, to lend money, that's never a good consultant.
Yeah.
That's also part of the assessment. And I've never spoken about financial models. The financial model assessment is, sorry, for me personally, everybody might see it completely differently, is the easiest part. Why? I have never seen a financial model when a company has been taken over, which provides me that the company is going bust.
I can imagine. One of the things that you said, Miriam, that I thought was quite interesting was about how, even though, say, some of our members or some of the others in the surety sector might be less familiar with in working in this environment, you said it's quite a standardized processes, or there's a lot of standardized processes. Can you talk a little bit more about that? What can people expect?
Sure. I think that the really good thing is that it's a very professional environment, and I would really say that most of the private equity players are very professional. That means when they want to buy a company, they usually provide due diligence reports about the financials. That includes the historics, but also the business plan. You receive a commercial due diligence report about the market, about legal topics, about tax topic, about structuring, about insurance, about environmental topics if are required. So, I mean, you can read through everything and you can learn everything about that company, and you most likely will also have access, I mean, either via the PE, maybe to management, or you can ask the private equity teams what the strategy is, or you can ask the due diligence providers about the questions. But you need to read through 500 plus pages. I mean, you're able to understand everything, but it's a lot of work to read through that. And that all filters into the fancy financial model Markus already elaborated in. So it's very transparent when it comes to the information basis. That's one part. So you have a lot of access to information. You just need to work through that. The second part is, I would also say there are certain standards when it comes to the documentation. Usually we have a facility agreement, and the revolver or guarantee facilities are mostly part of that. And you have an credit agreement that clearly, I mean, provides the ranking between equity and the debt partners. And you know whether you are pari passu or you are super senior. So there are certain standards, yeah. And of course, there's always a negotiation, but certain standards are not kind of touched, and you know what you buy into. And I think this is one of the big advantages of that industry. You also need that because every analysis of the company is usually complex enough to spend a lot of time on. So we save some time then on, I mean, not really on negotiations, but at least the standards help to make it work.
Yeah. There's a question that's come in. Oh, sorry, Markus, do you want to go ahead?
Yes, we have some questions.
Yes. Well, there's one that kind of touched on something you said, Miriam, and maybe a slightly provocative one as well. But someone is asking to Miriam and Stefan, when would you consider giving a senior secured position to a surety insurer? Is that something that you would consider, or is it something you have considered?
I mean, my understanding is, I mean, if, for instance, if there is a financing, you have, I just say a term loan B of 500 million, you have a revolver of, say, 100 and 100 million guarantee facility. Usually, if this hits all in one contract, I mean, all this 700 million participate pro rata in the security package, yeah, for this 6-7 year financing, and the voting rights apply to that. Of course, you could also have a situation where someone tries to do the guarantee business outside of that. Personally, I'm more against that, because if this guarantee element is an important part of the financing, and it's really important also for the company, I would rather want to avoid a situation where that insurance provider would fall away for whatever reasons, because it leaves, I mean, the risk and liquidity requirements at my desk, probably at a point in time where I have a lot of other issues as well. So I can see that maybe some parties try to push them out of the security position, but my personal view is I would rather vote for the certainty for 6-7 years and everyone is aligned.
Yeah, I mean, I can only underline this. Of course, me as a private equity owner, I need stability. So I think we need to differentiate the guarantees I need, be it down payment or fulfillment or whatever guarantees. We always assess this very carefully, what is needed going forward to also cater for the growth we are aiming at, so that we have a more than sufficient framework agreement, be it a cash revolver plus a guarantee line, which is an ancillaries. And in those ancillaries, we see Zurich or Swiss Re or others taking the guarantees. And these will be fully secured like the revolver and the senior loans. So they are joining the package. On the surety side, this is a bit different, because usually you have a lot, kind of a high volume on paper. Yeah, so 10 million surety, but the real risk is, if at all, 1 or 2 million. So that sometimes is difficult to build in, because I may need a nominal value of 100 million sureties, but that may bring an explosion to the basket, yeah, if I have a certain EBITDA and so on. So can I, for each and any nominal euro for the sureties, give super senior security? Likely not. that would, but to be honest, on those 14, or I was MD at UniCredit before, the last 24 years, I have not seen such a massive amount of sureties needed in a business, because that may then be very much a project business. And usually private equities, we don't love project risks, because if there is kind of you erect a pipeline or a huge barrage or something that has a project risk, which is very difficult for us to assess. So usually you won't see a lot of private equity companies buying project management companies. So therefore, I think the surety, if there would have been an issue, we have a company, Deubert, they are having sureties in the US, but those are relatively limited, and they are, I think, if at all, locally secured. So you have a basket, and yes, we can take those, but they will, in principle, not generally participate in the full security package.
Okay. Markus,
Daniel, maybe I'm allowed to comment what Miriam and Stefan said. I agree to both, and of course, do we like from our community to be senior secured, but in case we have complete transparency and trust into the PE, and exactly what Stefan said, it makes no sense, because the real underlying risk is not the nominal number on the piece of paper. You can sometimes live with, let me say, the lender syndicate provides you, let me say, 20-25% or whatever cash collateral provided by the syndicate, or even non-secured. But that also sometimes has sometimes then to do, you're not committed for the same period, but everything is possible. But the critical point is transparency and trust.
And I guess there's another question that came in that maybe ties into this, and Markus, maybe you can look at this one, which is, how do you gauge the success of a PE-owned company's business strategy? What would you look for, and what do you think is key in that part?
Oh, that's one of the most complex and critical questions.
I'm sure.
I'm trying to answer it quickly. First of all, is I'm at the final end, I'm looking in a financial model. I'm never looking in a financial model at the beginning. I'm looking into how, with which partners the PE is structuring a deal, doing all of the due diligence work. That means, have they done the complete due diligence? Now, a question can come up, what means complete due diligence? I personally use Accenture provided a couple of years ago a sheet of 3 pages, what has to be done in a due diligence. Or if you look into Germany, we have the restructuring, let me say, statements, S6, let me say, opinions. I use that as a guidance. Has the PE done the complete work like for an S6 piece of paper? If so, who have been the partners? Do have they the track record? Do they provide normally the quality? Then I could say yes. And the next is, I personally hate to work together with new PEs. They have to provide evidence for a couple of years that they have a positive track record. The second or the third point is, they should have a meeting with the surety first to present themselves, to present their normal strategy, their understanding of PE, their understanding of transparency. And then with each and every new partner, do not start with hundreds of millions of exposure, start with small caps. Then you can have, and it would be extremely good if you have an experienced bank being part of the game. If it's also a bank which is not so experienced in leverage financing, no thanks. And I have not spoken about the quality of the company yet.
Stefan, I assume, Stefan, that would be a similar viewpoint that you would have as well.
Yeah, I mean, what can I say about competitors? But I think you need to look at the track record, obviously. And if you can, as I said, show nobody has lost money with the Triton deal on a guarantee or surety the last 15 years, that tells you something. So it doesn't mean you can always have a first time, of course, but try to get convinced about a deal. Yeah, you are invited. And if there is something, a meaningful guarantee volume or surety volume, we from the very beginning invite you to be part of a deal, part of a due diligence. and make you comfortable, have a call with me or my colleagues and what the strategy is and how can you achieve this and that and that. And at the end, I think you need to make your opinion deal by deal, because even after 15 years, we can make a false decision also at Triton. And if you are not comfortable with the arguments and investment fees is provided, then yeah, if I can't convince you, then you better don't do the deal.
Yeah.
I would like to add one thing, because Miriam mentioned a very important topic before, how to assess market standards. If one of the partners is not, or let me say, is playing around with these market standards, which are more obvious for more than a decade, then I personally have a very silly formulation. It stinks.
Yeah.
That makes sense, I think. We've kind of looked at it now from the perspective of the surety looking at the PE-owned company, but if we take a moment to look at it from the opposite direction, and Stefan, what is it that you think is helpful when you're working with a surety? What do you like about working with sureties, and what do you think sureties can do better when you're working with them?
Yeah, I think also now touching credit insurers and whatsoever, the last thing we want is surprises. Yeah, so you can always, if you are a lender and you have questions, please raise them. And if you feel, oops, the CFO is not answering them properly, then give a private equity company a call and say, guys, yeah, we have an issue here and there. And yeah, if your contact, I mean, with a lot of, like with Markus or with others, we know and they know whom to call. So if there is an issue somewhere in our portfolio companies, I will receive a call and say, oops, yeah, Stefan, tell me what's going on there. What I hate is if, for example, credit insurers just overnight cancel limits without any prior warning and whatsoever. And that is, how can I handle this? Yeah, this is very difficult. If they are feeling, well, we have not been informed well enough, well, speak up from the first minute. And as I said, it's a Triton policy. You will get the same reporting package as the lenders. There's no reason to hold back. And that should give you the comfort, oops, there is no liquidity issue going around or anything imminent or whatsoever. There's no covenant breach. I mean, we did not talk about covenants so much. Usually private equity deals in these days, they have covenants and they are, yeah, in a way protecting you very well, because they are set at limits where the lenders can easily, in a distressed scenario, sell the whole group by a share pledge enforcement and still get their money back. Right. So if there's a covenant breach, the surety and the guarantee providers and so on, they should all be informed about it. And especially they should be informed that there is also a solution in place. Yes, with lenders, we have agreed a new covenant set or whatsoever. So there's no imminent risk that the company falls apart tomorrow. And I think that is something which needs to be valued. And I can only encourage everybody to build up the kind of one to whatever person, department inside their organization to say, okay, and here's the center of competence. Whenever we have a PE involved as a shareholder in one of our borrowers, this person needs to be involved. He will have the experience, okay, who kind of is on my white and on my blacklist, and then see at a certain deal and how do we get infos or not. If the sponsor is very reluctant to give you info, that is not building trust. So how can I expect you to lend a lot? So please build own expertise. And at the end, if you have it and somebody else doesn't, you can charge for it. I mean, I don't want to encourage anybody to overcharge, but we as private equities, we pay for stability. So if you go there and say, yes, this is our framework agreement for this year, unless your numbers deteriorate, we are having this and that and that. That is what we love, and we are willing to pay for a service we get. But what I hate is that I first need to find out who in France was responsible for a certain decision, which even the local manager, being the counterpart for the company, doesn't know about. And then I need 1 week to maybe get a call back from somebody who has not worked with private equity before. I cannot solve this solution then, and that is then maybe at the very end also backfiring against the party providing credit insurance, sureties, or guarantees.
Right. I think I'll come to Markus in a moment to see if he has a response to that. But Miriam, do you have a similar experience when it comes to the split between, say, the guarantee and the trade finance elements as well?
In terms of that, I would like to know where they stand. I mean, I think it's really different when they are part of a larger agreement. I think it's quite easy because then, and I also saw a question in the chat popping up. I think in the end, the insurer is just another bank then in the consortium, right? I mean, if you are a secured pari passu, everyone is equal. You sum up all the facilities and you calculate your voting share by just the amount against the total amount of the facilities. Then I would not say it's then banks and insurers against Stefan, it's not how I mean it, but you know what I mean. It could be a situation where the banks and the insurers have a call among themselves to coordinate, to discuss a proposal that has come from the private equity owner, and maybe sometimes they have some minor adjustments and would like to amend bits and pieces of that, right? So usually then the calls are then done by the ones that are kind of grouped together according to the intercreditor agreement. What is even more difficult also for me is the whole credit insurer part. Even for instance, if you have factoring in an LBO financing and the factorer also is back-to-back insured by credit insurers, this is, I mean, I'm completely blind on that end, right? I mean, I might get surprised because the factoring limit where I thought there is an additional line that is provided for 3 years, it just the limit might fall away, right? I think they've also learned after the global financial crisis that it's not very clever to force, I mean, some companies into insolvency when this has happened. And I think also during Corona times, you have seen that there was a steep learning curve on that side, but this is completely intransparent to me, I have to admit. And of course, if larger liquidity needs are done by parts outside of the normal consortium, and you have elements like that which you can't control, that's always an issue. But I have to admit, in reality, I've not really seen that post-financial crisis, that really it came to a complete blow up. Yeah, and I think Corona was a good test, in Ukraine war as well, I think.
Right. Markus, then what's your response to that?
Oh, trying to make it simple, to sum it up, we have a competition between the investment theory and the credit theory, or credit investment view and the credit view, because sometimes the investment view has to do things to increase the yield, which is against the credit view. Or in other words, sometimes the lenders, I include trade credit and surety as lenders in that perspective, cannot participate in the potential of potential earning, but they will be part in case something goes wrong. That's not a criticism, that's part of the business. And this is maybe one of the core challenges between the partners, that everybody understands the, let me say, the relation between investment view and credit view, and to bring that together that it can go ahead. And especially in critical situations when we need a waiver, or think about if we have bondholders in a critical situation with a PE, they sometimes have a complete different view, right? How to manage all of these lender types that it goes right in the right direction. And yes, Corona and the financial crisis first have been damn good, let me say, test scenarios how it might work.
And are there things that a surety can do as well that simplify it? For example, I think we talked before about having dedicated people involved who look at PE-owned companies as well. Are there things that they can do to put themselves on the right foot to start with?
Exactly. Or to sum it up, it makes no sense if you have damn good analysts, right? Corporate finance, which are doing their job extremely well, better as I in my life could ever do. But PE or leverage transactions is a little bit different, and you need specialized people which are doing that on a regular basis, also to learn is a standard really a standard? Or how is one of the partners playing with that? Which means specialized knowledge for disciplined underwriting. It's extremely important and one of the keys. And again, communication and transparency, which is much more important as for a normal corporate loan. Sorry for that. It's not the easiest thing, but this one is more complex.
Yeah, I guess you'd agree with that, Stefan. You're on mute.
Yeah, no, sorry. Yeah, cannot agree more.
Excellent. There's a question here as well that is directed to you, Stefan. So let's have a look at that. What methods do you find are best for incentivizing management for profitable growth, especially towards the end of the investment, when a liquidity event may occur before the ultimate results of current management decisions become apparent?
Well, in principle, our managements are heavily incentivized. They can, or they need to take substantial more money in their hands when invested in the deal, but of course it is on very, very sweet terms. So usually we want to do 2.5 times our money in 5 years, so an IRR of 20% plus. If that happens, usually management gets minimum 10 or more times on return on their money, so there's a leverage going towards them. The downside would be if we do kind of a less successful exit, which means if there's a liquidity event and some kind of, the company value is going not up but down, who's first hit? Management. So if we would only do 1.5 times our money, then maybe management has, if at all, got their money back. So they are incentivized very, very excessively or progressively on the upside, but they may also lose their investment. So I would say there is a joint effort or joint approach, and we are sitting in the same boat. There should never be any liquidity event because that's value destroying. And that's why our companies are obliged to do a 12 months liquidity forecast, a 12 weeks liquidity forecast. And if they don't, and the CFO says, well, this is impossible, we'll find a new CFO. Because we cannot fly in the fog and not know and then be surprised and need to inject money because of whatever liquidity event. Buy and build means our acquisitions will either be funded partially by debt or 100% equity. We have also had risk cases. And there's always an updated business plan with liquidity and guarantee demands, surety, what do have you. And we will make sure that over the next 2-3 years will fly. So we cannot be surprised ourselves, oops, now it's really growing 20%. And now we have a working capital issue. And now, because otherwise everybody loses money, lenders are forced to increase their revolver. So that's not how we work. That's right. Not that will put us on the shit list of Markus or somewhere. I don't want to be
there. Well, I guess to a certain extent, this is avoiding things going wrong, and this is making sure that you're working on the bright side of things. But say if a bond is called, we have a question about this. How can sureties, banks, and PEs work together when there is a call on the bond? Markus, maybe, or Stefan,
usually this shouldn't happen. I mean, a good CFO and a good CEO, this means there must be a customer who is deeply dissatisfied or something has really gone very wrong. As even if we buy companies, we want to have a clean track record. So no bond has ever been called is a key due diligence item. Otherwise, if you have a history which here and there, and so every 10th bond gets called, that means you have a shitty business, because this is the last thing a customer does and the end of a relationship. So if this happens, that's very, very bad. It shouldn't come as a surprise. It may be for political reasons or something that you can't avoid it. But if a bond is really called, we need to see why it happened and where to bridge the gap from. Is there enough revolver facility or whatsoever? And it will then mean there's a serious update for the liquidity plan next 12 weeks, next 12 months. And if there's a gap to be bridged, which can't be done from the revolver or elsewhere, I mean, guess where all eyes are on? Yeah, they are and on me. And usually we would, in that scenario, try to get the money because we don't want to lose the company for a liquidity issue if it's otherwise sound.
Yeah. Miriam, what's from your side of things, what would that look like?
I just have to ask, calling a bond means like a warranty bond that the customer has drawn. Okay, yeah. I have to admit, I think I've not seen that in 22 years of leveraged finance. And as said, I mean, doing deals in Germany with a lot of manufacturing companies, we also have a lot of companies where guarantees are required and all kinds of guarantees. I fully agree with Stefan. When we look at a company that has guarantee requirements, and usually it's clearly laid out in a legal due diligence, whether there have been drawings in the past, and if there have been drawings, what were the reasons? If that was maybe due to production issues at that point in time, and that has been resolved, that might be something you can think about. But usually you see that very rarely. And then, of course, the next question could be, when you could also have a drawing? That's probably at the point of insolvency. Yeah, luckily, I did not have that situation. But also there, I would say it's quite clear if there is a certain value that should remain within the company, the whole guarantee and operational part needs to survive and needs to progress also in an insolvency scenario. Therefore, I just simply think that also the insolvency administrator probably looks different to insurers and banks that provide the guarantees compared to maybe the pure term loan that financed part of the acquisition financing.
Mm-hmm. Markus, what do you think?
First of all, I would support both opinion. Or in my words, in case the CFO or the treasurer, whomever is responsible within the company, has not provided a heads up to the surety that there might be a calling of a bond, the assumption is something stinks. Is it solely the management within that company? Or is it really that something is wrong with that investment? Consequently, based to the question, that means we're always talking first to the company itself. If it's clear, fine. But nevertheless, if we believe, hey, that might be an assumption that it's smelling a bit, we always talk to the PE company and say, hey, we need some more trust. We need some more transparency. And that normally works. We extremely seldom are talking to the banks in that regard because it's more the responsibility of the company, as long as the company will not go insolvent or is nearly insolvent, in brackets. But it has a sometimes dramatic impact on the business model, liquidity plan, and whatever, which might cause some actions on the PE side. And therefore, our main focus is company first, second PE, and then it would be third the bank. But we do not have the right to go so far. Therefore, we normally stop at the PE side.
Right. Just looking at another question that's here. Maybe this is one for you, Markus. What's been the experience of getting the PE firm to sign surety for guarantee or bank facilities?
I'm not sure how this question is meant, to be honest. Mm-hmm. But if that's the meaning to participate in that part of things, the experience good, otherwise I would not be here. And two partners we're working together with would not be also part of the panel, but it's not my responsibility, and I'm glad that they're here. The experience is good, but not with all. Think about what I said, blacklist. Stefan said shit list.
Oh, sorry, yeah.
Another word, because it's straight to the point.
That's what shit is, black.
Yeah, right. No, to be honest, the experience is good. And first of all, talk to the responsible managers. That's the key. It doesn't work in each and every case, but it's workable.
We still have some time for questions, so to the audience, please do send in some more. Clearly, we've got a panel who is enjoying the back and forth on this, so get some questions in. Maybe if we look to as we start to get towards the end of the conversation, what are some tips that you might have for, say, the sureties that you work with, or in general, what when you're looking at this market, what are things that you really think should be honed in on as a takeaway point? Maybe Stefan, if I start with you.
Yeah, I tried to already mention it. Please make somebody, or please make it a central point of contact for private equities, where people like me, I mean, other private equities also have financing professionals. Who can we call? If that's kind of done, and for example, Euler Hermes, we try to meet once a year and then go through the portfolio, and then they have a flavor and are happy. So we love to have a central point of contact. We will please you and get all the infos you want, and make sure that you are treated fair by the portfolio companies and nobody forgets them. But this can only be done if I know whom to call, and I cannot cover in 40 states in the US every local surety provider, where we maybe in that state don't have a surety this quarter, but maybe next year and so on. That's for me impossible. And as I said, if there is such a central point of contact, we may agree terms, conditions, and whatsoever, which may be even better what you usually on average get.
Right. Actually, one question is coming, which I think is primarily for you, Stefan. So before I move on to Miriam and her thoughts, this question is, what are common methods that PE firms will use to increase portfolio company value?
Yeah, I try to say that there are various, and Markus did the same, various types of private equity guys. I would say there is this extreme end where they go into a troubled company, try to get kind of money out of it from whatever, how, and drain it somewhere and press the lemon. And I would not try to get close to them if I would be a lender. And then there are the others, and that's more like the Cinvens and the Advents of the world, so the good to great business builders, and also build better business like Triton. So we love to buy companies which have been part of a conglomerate in Siemens or Evonik, being kind of neglected as a non-core activity for years, when there's usually not the best management in, because you are non-core and who wants to go there. And if and that's, I think, what Triton differentiates me, if we have a story and say, okay, this is what we really would need to do, reshaping production and reshaping product offers, and maybe go geographic expansion, we need a footprint in USA, and then do the geographical buy and build or growth story. That is also heavily supported by equity, of course. If you go somewhere on a green field in the US, that's usually equity risk. So those methods are there. We need to get growing companies. That's where then also the EBITDA grows, and that's where value grows. Triton is less happy about companies where we can maybe do a workforce reduction by 10%, and that then propels our EBITDA by 15%, and on that back we sell the company on 3 years later. I haven't seen this in the last 14 years, because we always are focused on what's the plan B if economy goes down. Okay, here's our operational improvement program we'll do anyway, and even if we get headwind from economic cycles, we still can increase value. That's what we love to do. If we don't have industrial experts developing such an operational improvement plan, we don't touch the asset. If we have no better ideas than squeezing a lemon, we won't play.
Right. Miriam, any other thoughts from you about, say, advice to the industry, or maybe even if we're looking, we had a session yesterday about increasing inflation and things like that. Does the economic cycle play into some of this as well?
Question. Let me answer the first one first. I mean, I just can echo that you should have a dedicated team, and this discussion I find quite interesting, because I mean, just coming from a bank perspective, I know that also internally, as I just mentioned, also for instance, our factoring colleagues within the bank also set up dedicated people that look at the PE cases, because they also found out it's a bit different, right? So I think that's at least an experience that a lot of detached financing types have made when they dealt with private equity clients. And on top, I would just say, I mean, it's also a bit about networking, right? I mean, you indeed should know the PEs, you should know the other banks, you should know the lawyers. And it's always good if you talk, because then you can understand, who works in which way and whom to talk if you need a second opinion. Yeah.
Excellent. Markus, if you've a kind of last thought on this as well, where do you think we should leave it?
Well, it's not plenty to add. I want to be a little bit more proactive and questioning the complete audience. Are you convinced that the PE market from a global perspective, how we defined it, it's a growing market with all of the regional differences, yes or no? And the second is a cycle where we have high interest rates and a high inflation is counterproductive for PE market or not? I don't want to have an answer because that's a very challenging question, to be honest, if you ask me personally. And I can see Miriam and Stefan smiling, so they seem to support that a little bit. But we have an additional question, Daniel.
Yes.
I can say the simple answer is yes. So every CFO has the full freedom to choose to get 100% or wherever credit insurance on his receivables, wherever he feels it's appropriate. That's a micromanagement we from the sponsor side are not doing.
Exactly.
So we would, as I said, we try to hire best-in-class CFOs. They should have a risk management system in place, which customer gets what payment terms. And if he comes all of a sudden and says, oops, I have lost 5 million from this and that customer and it has not been credit insurance, he better has good answers why it wasn't credit insured, why it was 5 million, and so on and so on. So that's on a shareholder level, we encourage them to do so as long as the cost benefit analysis is positive. So it may be in Italy and Spain we do 100%, while in Germany we do 0. So that's the CFO decision.
Right. I think we have time for just this one last question, which is, are there bond types whose risk profiles significantly differ from one another internationally? Markus, maybe that's one for you.
The short answer is, my experience is no, but there's a slight add-on, because within the PE markets, when, like Stefan said, carve-outs, right, from large groups like Evonik or whomever, it could be Siemens, blah, blah, whatever, they normally work extremely with group guarantees, and when a PE is coming in, that has to be changed in real guarantees from third parties. Would it be the bank syndicate? Would it be the sureties, which might be part of a syndicate, or bilaterally? That's one of the big differences. But the underlying risk type of bonds is not changing because the business model is not changing, except the PEs are trying to finance more and more with advanced payment bonds, and therefore accept extremely lower margin and try to increase the amount of advanced payment bonds. But that's something investment theory against credit theory, and this is a challenge.
Excellent.
I think there's only one speciality for Germany I know about, that if you have a customs guarantee, this has a kind of more than 10 years kind of claims you can still do afterwards if there has been a book kind of an examination from the tax or customs. They can even try to charge you under a bond, although it already expired 10 years later. So that's for us in our due diligence always a key item. If we buy something, are there any such guarantees ever being granted in the last 15 years or so? And if so, can we be sure that kind of respective customs and all those payments which are covered by those bonds or guarantees are paid or not? If not, we better get a very solid seller guarantee or even cash to cover that. But elsewhere, I don't know specifically about US or Latin America or so, but this is usually, once we buy a company, we do a legal due diligence, and that is turning these stones, what risks may there be, even non-cash, but still in the books, and maybe catching you after 5 years or so.
Well, that's really helpful to know. One thing I do like to leave these conversations where there's still plenty more to be talked about, and I think it's a topic that we should try to come back to again in the future, but we've run out of time today. So I really want to thank Stefan, Miriam, and Markus for their time and for all of their efforts in helping prepare this in advance, and also to our audience for all of the questions that have come in. I think it's been a really interesting session, and as I said, I think there's definitely room for further conversations on this. That closes Surety Week for today. We have one more day tomorrow. We're looking at two quite interesting topics in a sort of taking a different shift from what we've looked at today. Tomorrow morning, we've got sustainability, and in the afternoon, we're looking at digitalization within Surety as well. So hopefully, if you haven't already, you can register for that and take part. But until then, thank you again to all the speakers, and goodbye.
Thanks to you.
Thank you.
Bye.